This is Ken Long from Tortoise Capital with a review of the weekend trading reports for November 28th, 2015. Happy Thanksgiving. Markets in bullish normal conditions. On an annual basis, looking at weekly RSI 14, we're in the middle range of neutral at 57 out of 100. On a short-term basis, using the 10-day NDX, we're at slightly overbought at 93 out of 100. Looking at the market mosaic, price with respect to the 200-day moving average is white bullish at 2.08% above the 200. Slope of the 50 is green bullish at 0.61. ADX has weakened to 15.8, neutral in terms of trending. The risk index is the 30-period moving average of the VIX divided by the 10. The threshold between risk on and risk off is 1.0. The current reading is at 0.968, which puts us just barely into risk-off conditions. Compare that to the last 5,000 trading days, finding the average and standard deviation of that period. We compute the risk Z at minus 0.45, so it's 0.45 standard deviations below the long-term average. And as you can see on the 90-day histogram of that indicator, it's improving, getting better. That is favorable for the long term. So if we can get through 212 here and bounce off the 200-day moving average, this is favorable for the long-term market. We are due for rebalancing in blended monthly systems on or about 1 December. These are the current holdings you see here, and then the current leaders as of Friday's close of business. In ETF2, the model's theoretical exposure is at 50%. The model portfolio will be at 80% exposed with stops in place. Just a quick look at the blended monthly rebalancing portfolios for the 13 and the 32. See about half are on buy signals with the U.S. in charge. In ETF Max, symbols that stand out of interest for me are ones that are in the green or the red on the 1 week rate of return. I'm interested in those because these are all the relative strength winners, which had the subsequent biggest follow through either for the positive or the negative. So sugar has sold off, global carbon is up, China technology sold off, small cap consumer staples was a big winner, 2.75%, and so on. So I'm looking for exceptional performance over 1 week and looking to find either rebounds or reversals or continuation patterns in these relative strength leaders. In the S&P 500, same thing. I'm interested automatically in Hormel Foods, which is up 10% over the last week. Tesoro Petroleum in the green. Cablevision in the red, and now it's been red now for 1 week and 1 month, giving back some of these gains of the 3 and 6 month period. So that could be a buy on dip opportunity. Tyson Foods at 16% for the week. Interesting. Southwest Airlines down 3%. So those are some short-term candidates that I'm interested in some momentum plays. Looking at the market health check, we have the vertical blue lines are 10, 20, and 30 days worth of look back, and the 60-day and the 30-day in the solid green. So we get a sense of the timelines. You can see the price and the dragon are out of the river, north of the midpoint of the river, which is the 30-period Bollinger Band plus or minus 1. The floodplain is the Bollinger Band plus or minus 2. You can see the 10-period regression channel sloping up and failing to fail this past week. The 30-period regression line still positively up. Oh, excuse me, all that turkey. In the last 40 or 50 days, we've had this nice double bottom placed in after the harsh sell-off of August. A nice recovery move, a orderly pullback, and now a nice rebound to test the all-time high up here around 212. So if we can get some motion through here, off we go. There was some negative economic news from the retail sectors with disappointing sales. So if that's a surprise to the market, we could see a sell-off in here, but if it's not too bad, it wouldn't surprise me to see a push through 212. There was no negative news this weekend of note to scare the world, so it may be that we get a continued decline in volatility and get a nice bounce. So we're at a critical state near an all-time high in a market that's trying to find its legs to get another leg up here after this harsh sell-off. So perfectly postured for short-term traders. In the ETF2 regional report, half of the symbols are on cash signals, half on buy signals. Strength is in the U.S. over the globals, with technology, large caps, small caps, and mid caps inside the U.S. And then the strongest sectors being U.S. large and tech, and then the weakest sectors being Latin America and emerging markets. Again, you see on the world market model here, everything in the U.S. is above average in the white, and the Dow and the NASDAQ are both exceptionally strong in the green. China and South Korea well above average in Asia, but everything else in Asia below average. All of Europe below average. The technology strength is a global phenomenon, and the consumer discretion is pretty strong in both, especially in the U.S., but also to a lesser extent globally. The big winners in ETF top 30 using the ETF2 lens, the Internet Index, regional banks, discretionary spiders in this third position, exceptional. And then all of these that are green and white are the new emerging leaders now that we've rolled away from income and back towards equities. These are the emerging leaders, consumer discretionary, U.S. tech, and then home construction. And we see the same kind of phenomenon here in the Dow 30 with U.S. large caps, fully half of them being in the green on strength. Nike, Microsoft, DuPont, McDonald's, and GE. Then the new strength coming in here, Coke, Disney, Boeing, Goldman, and only IBM and Walmart in the red down here. Shifting to the daily report. If we see weakness in the markets on Monday, we'd be interested in the U.S. mid caps and small caps for a one-day short side trade. Lots of goodies here in the auto framer, VIX, Goldman, Gold, Cliff, Brazil, Verizon, American Express. Many dojis from the low volume trades last week. An overreaction long in Disney, 5DD, and United Tech, and then only two symbols test out well on the auto framer. Again, same thing in the ETFs. Handful of dojis, a couple of the overreaction shorts, plenty to choose from here in the auto framers, and the auto framer stats for the ones that test out well based on a return to the 10-day high. You can see VIX at 7.3, Cliff at 3.4 to 1. And lots of daily squeezes here because of the low volume and small range on Friday. So you're going to see a lot of these. These are ones that had less than 70% of their average range on Friday. So they're kind of doji-ish in that sense. And yet have enough of a range stat volatility move available to give a favorable reward to risk ratio based on a range stat move divided by their range risk. So you can see we get a lot of things better than 2 to 1. Qualcomm, XIV, Gilead, Apple should be of interest to us. And I'll just flash through the remaining charts. Looking at the z-scores of the regression line slopes, the 90 continues to heal. The 10 is is through the 1 standard deviation barrier, and 30 has cooled off a little bit here, so we've had the nice move, one pullback, and then resting right at the edge of the river, poised to break out of this in a 210 to 212 range here. Failure to go further says we could come back to 204 and retest the bottom of the river. But if it does break out about 211, there's really room for another 5% move to the upside, which would take us to about 220. And that's everything I want to cover this week. Keep your risk measured and your powder dry. I'm going to be focusing on U.S. technology companies, Microsoft, Intel, Google, Apple, and then XLK and the Qs for my long side exposure. And selected materials like DuPont, and then I think Disney and Goldman are always of interest. So that's Ken Long from Tortoise Capital. Keep that risk measured and your powder dry.